Another brutal week for Mullen Automotive. As of Friday's close, MULN stock sits at just 69 cents a share, down roughly 39% for the week. But this isn't just another bad week in a long series of declines. This particular collapse feels symbolic, almost like the final bell tolling for whatever hope some investors were still clinging to. Because what we are witnessing is something even more alarming than the fall itself, it's the speed. Mullen's latest reverse stock split was meant to give the company breathing room, lifting the share price artificially above the $1 threshold to regain Nasdaq compliance. Yet barely any time passed before the stock plunged right back below $1. This was the fastest breakdown after a reverse split that Mullen has experienced so far. And it sends a crystal clear message to the market. Investors aren't buying the game anymore. Each reverse split, rather than restoring confidence, now acts like a starting gun for a fresh sell-off. Retail holders, battered by endless dilution and broken promises, are dumping their shares faster each time. Let's step back for a moment. Reverse splits, by design, don't create value. They simply shrink the number of outstanding shares and multiply the share price accordingly. The idea is to make a stock look healthier, to give it the appearance of strength. But without real operational improvements underneath, the market sees through the facade. And Mullen's operations have continued to raise red flags. Despite repeated assurances about vehicle production scaling up, tangible results have been thin. Sales of delivery vans, once a big talking point, have been modest. Efforts to break into the EV SUV space, like the MULN 5, remain years behind schedule. Partnership announcements have lacked clear financial impacts. And revenue figures, quarter after quarter, have remained disappointingly low. Meanwhile, expenses mount. Mullen is burning cash at an unsustainable rate. Even after reverse splits, the company has continued issuing new shares, further diluting the value of existing holdings. Warrants, preferred shares, convertible notes, all of it contributes to a steadily growing supply of shares chasing a shrinking pool of buyer interest. Every new share sold into the market is another cut to already wounded shareholders. Investor trust, once hard to build, has been shattered. When Mullen first burst onto the scene, it offered something exciting. A vision of American-made EVs competing in a growing global market. But vision alone doesn't keep a company afloat. Execution matters. And for too long now, execution has been missing. This past week symbolizes more than just a 39% price decline. It's the market's brutal verdict on management credibility. And it's not just about Mullen anymore. It's a broader reflection on how retail investors are reacting to penny stock games post-2021. The appetite for speculative hype is drying up. Real results, real revenue, real profits, those are the new benchmarks. And companies like Mullen, that fail to deliver, are being punished swiftly and without mercy. So where does Mullen go from here? Realistically, unless there's an unexpected, massive catalyst, something like a major fleet deal, a surprise merger, or a transformative cash injection, the path forward looks grim. At 69 cents, MULN is once again in danger of delisting from Nasdaq unless the stock regains compliance. But let's be honest, even if management orchestrates another reverse split to reset the clock, it's hard to see how that changes the fundamentals. Another split might buy time, but it won't rebuild broken trust. It won't erase the pattern of missed targets. It won't fix the cash burn problem or the operational lag. And each reverse split gets harder to justify to shareholders. Every time, it signals the same story: delay, not deliver. Could there still be a last-ditch rally? Maybe. If the company surprises with legitimate, revenue-producing news, a short-term bounce is possible. But in the absence of that, the more likely scenario is a slow drift lower, or even another round of restructuring. In truth, MULN today looks less like a comeback story and more like a cautionary tale. A warning to investors about the dangers of chasing hope over fundamentals. This week wasn't just about losing 39% on paper. It was about losing the last scraps of belief. And unless something major changes soon, Mullen Automotive risks becoming another name on the long list of once promising companies that couldn't deliver when it mattered most. Thanks for watching. If you appreciate real, no-nonsense analysis on the markets and the companies that drive them, or crash them, make sure to like, comment, and subscribe. We are here to cut through the noise. Stay sharp, stay skeptical, and I'll see you in the next one.